Okay, morning to all of you. So today we're gonna learn about financial ratio. Okay, basically what is financial ratio? So basically you have to get the sample or financial statement of the company where it consists of income statement and balance sheet in order you to compute a financial ratio. Okay, financial analysis. What is financial analysis? Financial analysis is use of financial statement to analyze a firm financial position and its performance. So you need to analyze the financial statement through you are doing the financial analysis. Okay, where through financial analysis you can know how the resource of the how the firm use the resource. Okay, and then is it adequate enough to invest in new project? Okay, and what are its sources of profitability by calculate the financial ratio. Okay, financial ratio analysis relative rather than absolute concept, meaning to say that financial ratio it depends on your financial statement, so you have to calculate the financial ratio, and then rather than you just rely on the theory. Okay, so financial ratio help readers to identify the financial strength and weakness of a firm. It is because after you calculate, you can determine whether the firm has enough liquidity or it's the profitability is reached at the maximum point. Okay, so financial ratio are classified into this one: profitability, liquidity, leverage, efficiency ratio, and also market ratio. Okay, as you can see here, this is the example of income statement of ABC Berhad. Okay, ABC Berhad income statement, where it show you the revenue and also profit before tax. Okay, and then the dividend paid and return profit carried forward. Okay, whereas this one, okay, show actually is statement of financial position, so it or balance sheet, so it show the non-current asset and current asset of the company. Okay, you see here there is also equity, non-current liability, okay, and current liability, which consists of this one, trade payable, okay, such as your supplier, or when you are firm and then you buy something, okay, in terms of credit, so it's called the trade payable. Okay, there is accrual, current tax liability, total liability, and etc. Okay, what is the benefit of ratio? Okay, first of all, because of it is very useful in making a decision. Okay, after you calculate the financial ratio, then you can determine what the firm have to do in order to increase the profitability or increase the liquidity. Okay, and that is also helpful in financial forecasting, helpful in communication, in coordination, control, and also help in shareholder decision as well as for creditor decision, meaning to say that the supplier can determine whether the firm also has a strong ability, okay, to pay, okay, in terms of creditor perspective. Okay, what is profitability ratio? Okay, profitability ratio is essential to analyze the ability of management to generate adequate profit from use of firm capital and asset. Okay, profitability ratio determine the firm bottom line. So the importance of ratio is you see from the gross profit margin, operating profit margin, and net profit margin before or after tax. Okay, you see the calculation of profitability ratio. The first one is under gross profit margin. So the formula is gross profit. Okay, you may see from the income statement that I showed previously. So gross profit over revenue times 100. So basically gross profit margin measure how much a firm earns from its revenue less the cost of goods sold. Okay, so gross profit margin is gross profit. you didn't deduct from any expense. So basically this one from the example, okay, you see the gross profit over revenue times 100, you will get 26.85. okay, so 26.85, meaning to say that for every 1 ringgit of revenue earned by the firm, it costs sales amount to 0.7315. ABC Berhad has earned sufficient revenue to more than cover the cost of sale. Hence, the positive gross profit margin, for example, okay, RM 0.26 or 0.27 of gross profit for every 1 ringgit of revenue made by a firm. Or you can say that for every 1 ringgit of revenue made by a firm, so the firm also have profit margin of RM 0.27 cent. Okay, this is the formula for profitability ratio for net profit margin. Okay, just now is gross profit margin. So net profit margin, of course, you have to take the profit before tax over revenue times 100. So based on the income statement, okay, you take the amount of profit before tax over revenue. So we get 7.22%. Or you can also take profit after tax if you don't have the profit before tax, okay, divided by revenue times 100. Okay, what is liquidity ratio? So liquidity ratio measure the extent to which a firm has adequate cash flow or liquid asset to meet the short-term liability of the firm. Means that liquidity ratio, it measures either the firm has adequate cash flow to meet the short-term liability of the firm, means the firm already borrow from creditor. So if you calculate the liquidity ratio, then you can determine whether the firm has the ability to pay. So for example, current ratio, asset tax ratio, inventory turnover ratio, account receivable turnover ratio, and account payable turnover ratio. This is all the type of liquidity ratio.